In my video to save or to invest, I mentioned that one alternative to cash, which is destroyed by inflation in real terms, is shares. So in this video, I want to introduce why people buy shares. Now, first thing to say about shares is they are the result of the creation of something called limited liability vehicles, otherwise known as companies. And they are, for some people, one of the best inventions ever. They massively free up capital markets and financial markets by doing one thing. And that is, if you separate the people who own a business from the people who manage it, shareholders from directors, all right, and introduce the idea of limited liability in the process, what you enable people to do is to invest in a company that they may know very little about, potentially, or have very little day-to-day contact with, take some of the returns out, all right, but do it knowing that should it all go wrong, the most they can lose is the amount they've invested, no more. They literally have, as a shareholder, as an investor, limited liability for the actions of the directors who run the company. So it means that you don't need to do the business yourself. You can invest in someone else's business, and if they get it right, you can make potentially decent gains, generate some income for yourself, and your maximum downside is the amount you've invested. And that's pretty powerful. Now, why would I buy shares? Well, at the end of the day, I'm not going to give my money to anybody. I'm not giving it to the directors to play with. I want them to make a return for me. So let's take a look at real returns. Real, by the way, means inflation adjusted from 1952 to 2010, provided by the Barclays Equity Gilt Study. Now, shares on the left, property and government IOUs in the middle, and cash on the right. Who wins? Well, over that period, fairly long period, shares have managed an average annual return of just below 7%. Is that impressive? It's not bad. Property, admittedly, this is unmortgaged property, ungeared property, quite a way off that. Government IOUs, slightly further off the pace still, and cash languishing back in fourth position. Why? Because the problem with cash is even if you earn interest, the value of your investment is being eroded by inflation. Shares, on the other hand, are capable of generating long-term some quite serious inflation-adjusted returns. Now, there are pitfalls, there are mistakes you can make, and I'll cover one or two of those in a moment, but that is the primary reason I would suggest why people buy shares. Now, quick example as to how these things work for people who are really quite brand new to it. A company needs starting assets of £100,000. Where's it going to get the money from? You can't just fabricate assets. You want to set up a business. Well, rather than going to a bank, rather than selling IOUs, fixed income securities, this firm decides to issue shares, 100,000 of them at £1 each. Very, very straightforward numbers. You buy 40,000. So there are 100,000 to start with. That's 40% of them for £40,000. That's your investment into the business. Now, you're not going to be running the business. You're going to leave other people to do that. But your investment is £40,000. A year later, the directors have done well. The assets are worth £200,000. Now, to go from there to there, they must have done something right. And we call it they've made a profit of £100,000. Okay, an increase in your assets, doubling them, means they've made a profit. Brilliant. So, what are your shares worth now? Well, all other things being equal, whether you can sell them or not is another matter. I'll cover that in a moment. But all other things being equal, your shares presumably have done the same thing as the assets of the business. They've doubled in value. And this is the point. You don't have to get your hands dirty with the assets of the business. That's the director's job. The point is you have a stake that presumably is now worth more like £80,000. All right. So, were you to sell out now, you've doubled your money too. You're not running the business. You may have paid no attention to it, but you've doubled your money. What's the most you can lose? Limited liability suggests the most you can lose is the amount you put in. So in hard cash terms, you can't be more than the £40,000 down that you put in. In terms of value of your investment today terms, if it all goes wrong tomorrow, yeah, you could be £80,000 down. But you can't be more than that down. What are your choices? Well, as an investor, you've got normally three choices. Buy some more shares, if someone will sell them to you. Hold on to what you got. It's obviously a fairly straightforward option and hope the directors generate more profits in the future. Or sell. How easy it is to sell will depend, in fairness, on the type of company you've invested in. Private companies, you're going to have to find a buyer. If it's a company that's public and listed on an exchange, phone your broker and the deal can be done fairly quickly. Okay, but nonetheless, your three basic choices: buy, hold and sell. And the point about shares, you can get in and out of them normally, where a firm is publicly available, listed, fairly easily. shares are generally, not in all cases, but generally fairly liquid investments. Okay, now, what are you expecting to get out of your share ownership? I mentioned one of the three things: future profit growth, which will improve the value of your overall holding, but let's not forget about income. Companies do pay dividends, and perks. All right? Holding shares sometimes entitles you to discounts on the company's products, for example. The income side is pretty important. Don't want to underestimate that one. Let's take my previous company and assume it paid a dividend of 20% of its £100,000 profits. Where would that leave you? Well, some people would say no better or worse off. And in overall terms, that's true. You've still got, if you like, an £80,000 stake. But the point is, some of it's now hard cash. The directors will have paid you, based on your ownership share, an £8,000 dividend. So you've got £72,000 left in the business and an £8,000 dividend. And you could go and spend that, but I strongly suggest you don't. Now, you're thinking, great, let's go out and get some of these brilliant things called shares. Okay, with the benefit of hindsight, why wouldn't you want to buy Google since 2004? I mean, just take a look at what the share price has done. Starts off bottom left-hand corner, and in today's market, wow, huge, huge gain there. All right, if you piled all your wealth into Google in 2004, you'd probably be retired and not watching this video right now. But that would be an incredibly dangerous thing to do, because the benefit of hindsight is a wonderful thing. Who knew that's exactly what was going to happen over that period? That's why we don't recommend piling your money into single stocks like that. You need to diversify and hold a basket of them. What sort of basket? Well, let's take a look at the wider FTSE 100. This is the top 100 companies in the UK market from 1984. You still do quite nicely, maybe not as spectacularly well as someone who took a gamble on Google. But here we go. All right, the index started at 1,000 points back in 1984, and it's gone up something like six-fold since then. Now, my point is this: along the way, there have been some pretty big bumps. There was a crash around 87. Okay, there's another dip just there. There's another one just there in the late 90s. There's a huge one there when the dot-com bubble burst. Another one there, the credit crunch. But like a heavyweight boxer that won't be felled, if you like, the FTSE has staggered off the ropes and carried on climbing. So here's the point: diversification will take away the single stock risk, but you need to also be prepared to hang on in there. Anyone who sort of panicked, somewhere like here and dumped their stocks, basically watch the market fall, will have lost quite a bit of money. People who hang on in for the long term usually do okay. So, diversify your portfolio, message number one. Message number two, don't panic sell. Don't be a forced seller when the market dips. Message number three, I mentioned dividends. Don't take them away from the companies you invest in and spend them. Why not? With income included. Let's redraw that FTSE 100 chart. All right, and here's the picture. Starting on the left, around 500 points, finishing on the right, okay, just shy of 5,000 points. That's something like a tenfold increase. So this is the FTSE 100 chart with income reinvested, with dividends reinvested. And the message I want to give you here is that if you reinvest income, two things happen. The chart gets a wee bit less volatile, a little bit less wavy, which is nice. And secondly, over the long term, you make a lot more money. How much more? Well, let's take a look. Bit of an extreme example, you might say, at £100 invested in shares back in 1899, what would that be worth in real terms now if you hadn't reinvested your dividend income, and if you had? Real terms means adjusted for inflation. On the left, barely moves. Okay, hardly worth the bother, a few £100 at best. On the right, the best part of £25,000 in real terms today from that £100 investment. That's the power of reinvesting income. And in case you're thinking, just out of interest, if I was a really cautious investor in 1899, I took £100 and just plonked it into cash, where would I be? I'm afraid the answer is not very wealthy. So in short, people buy shares expecting a decent long-term return, but hopefully, as you'll notice in this video, there are pitfalls you can fall into, and my message on the end of this video is avoid them if you can.